The IRS has a secret weapon, and it's not the 87,000 new agents that caused a national panic in 2022. It's not AI, it's not blockchain surveillance, and it's not some shadowy government supercomputer scanning your bank account in real time. It's something far more boring, far more effective, and something that's been sitting inside the tax code since 1943. And the reason most people don't know about it is the same reason most tax cheats don't see it coming. It looks completely invisible until the moment it isn't, because every year Americans hide an estimated $600 billion in taxable income from the federal government. That's the tax gap, the difference between what the IRS is legally owed and what it actually collects, $600 billion. And the IRS, working with a budget that has been cut by nearly 20% in real terms over the last decade, manages to claw back only a fraction of it, which raises a question that nobody in traditional financial media bothers to ask. If the IRS is underfunded, understaffed, and outgunned by an army of accountants and tax attorneys, how does it catch anyone at all? And if understanding the gap between what the government knows about your money and what you think they know sounds like the kind of thing worth understanding, hit subscribe, because that's exactly what this channel is for. Now back to the secret weapon. The answer starts with a number, not a dramatic number, not a headline number, just a quiet, unassuming number that gets filed by your employer, your bank, your brokerage, your mortgage servicer, and about 24 other institutions every single January. That number is the 1099, or the W-2, or the 1098, or any one of the roughly 30 different information return forms that third parties are legally required to send to the IRS every year. And here's the thing about those forms, they don't just go to you, they go directly to the IRS first. Before you file a single thing, before you've opened TurboTax, before you found that crumpled receipt at the bottom of your coat pocket, the IRS already knows, and what they do with that information is the foundation of almost everything that follows. Because the IRS runs what's called an Automated Underreporter Program, which sounds like a government acronym that means nothing, but actually means everything. Here's how it works. When you file your tax return, the IRS runs it through a matching system that compares every number you reported against every third-party form filed on your behalf. Your W-2 from your employer, your 1099 INT from your bank, your 1099 DIV from your brokerage, your 1099 NEC from every client who paid you more than $600. The system matches them all, automatically, at scale, across hundreds of millions of returns, and when something doesn't line up, when the number you reported is different from the number someone else already told the IRS about, a flag goes up, not a human flag, a computer flag, and that flag eventually turns into a letter, a CP 2000 notice, which is the IRS's polite way of saying we think you made a mistake, and here's what we think you actually owe. This is how the IRS catches the majority of underreporting cases in America. Not through audits, not through investigation, through a computer matching a number you filed against a number someone else already filed on your behalf. It's the tax equivalent of getting caught in a lie because two people told different stories to the same person. And it costs the IRS almost nothing to run. But information matching only works on income that gets reported, and the $600 billion tax gap doesn't come from people forgetting to include their W-2. It comes from cash, from self-employment income that never touches a 1099, from small businesses that underreport revenue, from landlords who collect rent in cash and report a different number, from sole proprietors who keep two sets of books, from freelancers who get paid under the table and figure nobody's watching. And here's where the IRS has to work much harder, because when there's no third-party paper trail, the computer matching system is useless, and the IRS has to do something much more expensive and much more targeted. It has to audit. And audits are not random. This is the most important thing to understand about IRS enforcement, and the thing that the panic-inducing headlines about 87,000 new agents deliberately obscure. Audits are driven by a scoring system. Every tax return filed in the United States gets assigned a score by a program called the Discriminant Information Function, the DIF Score. The IRS has never publicly disclosed exactly how the DIF score is calculated, but decades of tax research and IRS data have revealed the general shape of what it measures. It compares your return against the statistical averages for your income level and your industry. And when your numbers deviate significantly from what the average person in your situation reports, your DIF score goes up. And when your DIF score is high enough, a human reviewer looks at your return. And when a human reviewer decides something warrants a closer look, you get selected for audit. This is why certain patterns trigger audits at dramatically higher rates than others. Claiming a home office deduction on a W-2 salary when you have no self-employment income. Reporting business losses for 5 consecutive years. Claiming 100% business use of a vehicle when you have no other personal car. Reporting charitable deductions that represent an unusually high percentage of your income. Taking large meals and entertainment deductions as a self-employed individual. None of these things are automatically fraudulent, but all of them are statistical outliers, and statistical outliers are exactly what the DIF score is designed to find. Because if you look like everyone else in your income bracket, you are an inefficient audit target, but if your return looks like everybody else's, you become interesting. And the IRS is very interested in interesting returns, but the DIF score and the information matching system are both reactive tools. They wait for you to file and then they analyze what you filed. And the most sophisticated tax evasion, the kind that moves hundreds of millions of dollars through offshore accounts, shell companies, and foreign trusts, often doesn't show up on a return at all, because the whole point of the most elaborate evasion schemes is to make income disappear before it ever reaches a tax return. And this is where the IRS uses an entirely different playbook, one that most people have never heard of and that generates the largest individual tax fraud recoveries in American history. It's called the IRS Whistleblower Program, and it is, by almost any measure, the most cost-effective enforcement tool the federal government has ever created. Here's how it works. If you have specific, credible information about a person or entity that is underpaying their taxes by more than $2 million, you can report it to the IRS. And if the IRS uses your information to successfully collect unpaid taxes, you receive between 15% and 30% of the amount collected, not a flat fee, a percentage of however much the IRS recovers. And the IRS recovers very large numbers. Between 2007 and 2023, the IRS Whistleblower Program paid out over $1.1 billion in awards to whistleblowers, which means it collected many multiples of that in unpaid taxes from the people those whistleblowers reported. The program turns the people closest to tax fraud, employees, business partners, accountants, former spouses, into the IRS's most effective investigators, because nobody knows where the bodies are buried better than the people who helped bury them. The most famous example of the whistleblower program working exactly as intended is Bradley Birkenfeld. Birkenfeld was a private banker at UBS in Switzerland who helped wealthy American clients hide billions of dollars in secret Swiss bank accounts. In 2007, he walked into the Department of Justice and told them everything. The names, the accounts, the mechanisms, the techniques. The information he provided led to UBS paying a $780 million fine, the disclosure of over 4,700 secret American accounts, and the effective end of Swiss banking secrecy as Americans had exploited it for decades, and for his cooperation. And after serving 30 months in federal prison for his own role in the scheme, Birkenfeld received a whistleblower award of $104 million. The largest individual whistleblower award in IRS history, $104 million, paid by the United States government to the person who helped them dismantle the biggest offshore tax evasion scheme in American history. And then there is the net worth method, which is the tool the IRS uses when none of the others work. When there are no third-party forms to match, no statistical outliers to flag, no whistleblowers coming forward, and no paper trail of any kind, the IRS can build a case using nothing but math. The logic is simple. If your net worth increased by $500,000 last year and your tax return shows $80,000 in income, the IRS wants to know where the other $420,000 came from, because money has to come from somewhere. And if it didn't come from reported income, it either came from non-taxable sources, gifts, inheritances, loans, or it came from income you didn't report. And the IRS's job is to prove which one it was. The net worth method was famously used to convict Al Capone in 1931, when federal prosecutors couldn't prove his other crimes, but could prove that he was spending far more money than he was reporting. The same method is still used today. The math hasn't changed, the principle hasn't changed, only the scale has. And this is the part that most people fundamentally misunderstand about IRS enforcement. The IRS doesn't need to catch you lying. It needs to find a number that doesn't make sense, because once they find a number that doesn't make sense, the burden shifts. You now have to explain it. And if your explanation involves cash income that you didn't report, or offshore accounts you didn't disclose, or business revenue that somehow never made it onto a return, well, now you have a different kind of problem. The IRS isn't trying to prove what you did, it's asking you to prove what you didn't do, and that is a very difficult position to argue from. If this is the kind of breakdown you want more of, how the systems that govern your financial life actually operate underneath the surface, the Sketchbook Finance newsletter covers exactly this every week. Real mechanisms, no noise, completely free. The link is in the description below. But here's what the $600 billion tax gap actually tells you about IRS enforcement. It tells you that the system is not designed to catch everyone. It's designed to catch enough people that the rest stay scared. Because the real enforcement mechanism of the American tax system isn't the audit rate, which for most individual filers is less than half of 1%. It's the belief that you might get caught. It's the uncertainty. The knowledge that somewhere a computer is matching numbers, that somewhere a DIF score is being calculated, that somewhere a former business partner knows exactly where